Hello everyone, my name is Omar Alwani and I'm one of the co-manager at ROMM Inc. Today I'll be going over our strategic vision, year 11 and year 17 wholesale strategies in North America market segment. First, I will start with our strategic vision. During our first co-manager meeting, we discussed the importance of deciding on one of the fortunate strategies early on to help guide and focus our effort in the games. We also knew that we will need to pursue different strategies in different markets to help create a sustained and lasting competitive advantage. We wanted to manufacture the highest quality shoe for the lowest cost possible to improve shareholders' return on investment and make ROMM Inc. one of the top shoe companies in the world. Moving on to year 11, we decided to pursue a focused differentiation strategy in the North America market segment by creating average model numbers and higher quality, as we assessed that most companies in the industry will potentially either choose a cost leadership strategy or a broad differentiation. However, our initial assessment was wrong. As you can see, almost 80% of the companies in the market choose the same strategy, which suffocated our market share and significantly affected our projected profits. Company E, as you can see again, emerged as the clear winner during year 11, which we assess was primarily due to their broad differentiation strategy as well as their cost leadership. During the period between year 12 and 16, we decided to take a broad differentiation strategy as well, as we assessed that it is the most beneficial strategy financially in the North American market segment. But again, companies such as A and C, as well as market leader F, during that time period, were also following similar strategies, which created intense rivalry, drove production costs up, and profit margins down. In year 16, we ended up in the 5th place in our industry. Moving on to year 17, we realized that we will have to take extreme measures to differentiate from our competitors. So we decided to lower our shoes SKU rating significantly in the North America market from previous years, and also max out on our models. While this strategy did not have any significant impact on our market share, it increased our operating margin by over 10% and also improved our net profit by almost 50%. In conclusion, as a team, we were able to continuously improve and evolve our strategy to respond to the changing market as well as the changing strategies of our competitors. This technique allowed us to move from number 7 in year 11 to number 3 overall at the end of the games. This concludes my portion of the brief, and I'll be followed by my co-manager, Mary Lindley Albert. Thank you.
This next section chronicles ROMM's financial indicators. These financial indicators are extremely important because they show the overall health of the company and provide a wellness check. Further, they keep the company accountable to key stakeholders to deliver a quality level earnings per share each year and show overall financial health with net revenue at the end of every year. Starting with ROMM's earnings per share, it's important to note that the company continually saw gains. There was not a period of time or a year where the company lowered its earnings per share from the period before. However, while that data is important, it's also important to look at the percentage increase year over year to show how well the company is doing. By looking at the graph, you can see that years 11 and 12 have a smaller earnings per share percentage increase, whereas the middle years, 13 through 15, have a much larger percentage increase, and 16 and 17 taper off with a slightly smaller earnings per share increase. The small increase between years 11 and 12 show that the company was still trying to figure out its overall strategy and how to best implement that strategy. The middle years show where our company hit its stride with its strategy, and the latter years show how successful that strategy was. Overall, our earnings per share increased year over year The financial health of the company is shown as in year 11, the earnings per share or EPS was under $2, and by the end of year 17, the earnings per share was over $11 for an overall increase of nearly 500%. The next important financial indicator is net revenue. Net revenue is comprised of what money is left over after all bills have been paid and excludes the cost of goods sold. So this dollar amount is the bottom line of what's left after the company has performed all necessary purchases at the end of the year. The net revenue metric is more important than the revenue metric simply because only counting revenue does not take into consideration the cost of goods sold or the cost of doing business. Therefore, one could be increasing revenue but not necessarily having much left after all bills are paid, whereas using the net revenue metric shows what the company has to show for its labors at the end of every year. A stock price is an important financial indicator because it shows the investor perception of a company. If the stock price is higher, that means investors think the company is doing better, and it generally means that the company is in a better financial state. ROMM stock performance is cyclical and can be divided into 4 different sections. The first section, ROMM saw a shorter growth period. The second, an intense growth period. The third, followed by a slow growth period, and finally an intense growth period again. This cycle reflects the company trying to determine its strategy, finding its strategy, realizing some of the methods it took to maintain its strategy weren't always effective, and then really honing its strategy towards the end of the term, or year 16 and 17. Even within the slow periods of growth, it's important to note that the stock price of ROMM never fell. It was continually growing and started very low in year 11 and ended very high in year 17. As indicated on the graph, ROMM stock prices saw an almost 250% increase from year 11 to year 17, showing overall financial health of the company and that the company can continue into the future, despite any shortcomings or mistakes it might have been made.
Hello, my name is Robert Probst, and I will be presenting the competition portion of our business plan. So our closest competitor to ROMM was Team E in both the internet and the wholesale markets. ROMM in the internet market captured 12.6% market share, while Team E has 12.8% market share. The reason they are our closest competitor is because we had similar competitive strategies. Team E specialized in many different product lines, and at the same time trying to keep efficient costs in order to not pass high costs onto the consumers. For example, both ROMM and Team E had 500 models that they were selling. The difference was that Team E did price their shoes slightly higher than ROMM did. At the same time, Team E also had a higher SQ rating, which enabled them to increase prices while at the same time capturing a larger section of the market share. It's important when you're pricing these models not to overprice or underprice your models, because if you overprice the models compared to your quality, you're not going to capture a high enough market share. And at the same time, if you underprice the shoes, then you're going to sell out of your shoes, which is going to really harm your credit rating as well as your image rating with the consumers. So our ROMM competitive strategy moving forward will be to try to outcompete and overtake Team E in the next few years. So in the past, Team E was successful in capturing a large segment of the wholesale market as well. They captured 17% of the market share, while ROMM only has 9%, so they almost doubled our market share. So what we can do over the next few years is try to increase our SQ rating, which will enable us to increase our pricing. At the same time, we can work on increasing our production capabilities in order to meet the higher demand that will come with higher quality shoes. We also would try to capture larger market share by underpricing Team E. If we're able to raise our quality closer to what Team E does, and at the same time keep the prices lower, we will be able to capture a larger segment of the consumers. Uh, we also need to increase our prices in the internet segment because we seem to be underpricing our shoes at the moment compared to what the demand is dictating. So if we're able to increase our pricing closer to what Team E is, we're going to bring in higher net profit and have more capabilities in future years.
Thanks, Robert. Moving forward, I'm going to talk about the lessons learned that our co-managers got from this simulation. So first up is some things that we learned along the way, mistakes to avoid. So first and foremost was overspending on marketing without producing at a capacity to meet demand. We knew this going into it, that you didn't want to be the team that was producing less than there was demand, but unfortunately we did get a little bit ahead of ourselves in year 13. We did see that in every region, we ended up losing pairs because we weren't able to meet the demand. We increased our overall brand advertising in 3 of the 4 regions. We increased it in North America, Europe, Africa, and Asia Pacific. And in all 3 of those regions, we saw almost at least 100 pairs demanded that we lost because we weren't able to meet that demand. So that was definitely a mistake that we made that we would recommend avoiding for any organization. You want to make sure that you're able to meet the demand that you're marketing for. Additionally, another mistake was taking on too much debt too early on. We started off in year 11 with total liabilities of $134,824 US dollars. And that just kind of set the tone moving forward, that it almost felt like it was difficult to get out of it. So we ended up taking on more loans moving forward to try to pay off some of that debt. So that was definitely another mistake to avoid, because it overall kind of prohibited some of the decisions that we could make in other areas, because we weren't able to put our funding towards that, because we were trying to make sure that we weren't taking out more loans unless we absolutely had to. Another mistake to avoid is staying stagnant on a strategy that's just not competitive in the current environment. When we first set out on this simulation, we really wanted to do a focused differentiation strategy. We wanted to produce the highest quality products. Unfortunately, we learned after a couple of years that it turned out most of the other teams in our market, in our industry, were pursuing a very similar strategy. So it didn't really make sense to keep pursuing this strategy when it wasn't getting us any additional benefit, because our competitors were doing the exact same thing. Some strategies that are good to pursue then are to reevaluate the strategy on a regular basis. After every single year, we went through and decided whether or not our strategy was still working. So we pursued the focused differentiation of trying to have the highest quality products for the first couple of years, but by year 13, we saw that that just wasn't working in our environment. Because we periodically reevaluated the strategy, we were able to notice that pretty early on. As you see in point 2, another success was committing to a strategy and giving it time to fail or succeed. We gave it 2 years. You know, each organization, each team is looking at this data and making strategic decisions, and you can only hope that you are correct in what the other teams are deciding. But we didn't want to completely alter our strategy after just 1 year of not seeing success, because what if other organizations were doing the same thing and we hadn't quite given it time to fail or succeed? Just because we didn't see great numbers in year 11 didn't mean that we couldn't see them in year 12 by slightly altering something. So definitely give it that time to fail or succeed, but make sure that you're staying on top of it to make sure that it's working. We did go ahead and decide in year 14 to change our strategy. And that did go ahead and bring success. So because we kept evaluating it, and because we gave it time to either do well or do poorly, we were able to identify what was and wasn't working and make changes as we best deemed fit. Another strategy that is a good idea to pursue. Another lesson learned is to make sure that you're growing your manufacturing and production capacity at a reasonable rate. We set off in year 11 that we wanted to go ahead and open production facilities in the Europe, Africa region, as well as Latin America, because we saw that as an opportunity. Obviously, there's a lot of other things that money can be spent on throughout the entire simulation, just as there are with running your own business. There's a lot of decisions to be made all of the time, and you have to determine where you're going to allocate all of those resources. But you want to be able to make sure that you're able to meet demand. And in order to meet demand, you have to be able to have the production capacity to do that. Just like we discussed in the mistakes to avoid, if you want to be able to increase your advertising spend to reach more customers, you have to be able to have the facilities, have the capacity to meet that demand. So this looked a little bit different for us each year based on where we were, what particularly we were doing. But throughout year 11 through 17, we did increase our production capacity at an average of 13.6% per year. In that first year, we increased 12.5% from a total capacity of 8,000 units to a total of 9,000. And we kept going from there to towards the end of year 17, we had a capacity of 17,000 units. So you want to make sure that you are continuing to grow your capacity at a reasonable rate. And by reasonable, we mean you don't want to go in hard with increasing every single region, because then you're not going to have any funding to do pretty much anything else. You want to make sure that it's at a reasonable rate, because it also doesn't make sense to increase your capacity to, the absolute maximum that you can afford, and then there's not even a demand to utilize all of that capacity. So you spent all of this funding, all of this time and energy producing these new facilities, this new capacity, and there's nothing even being used. So those were a few of our lessons learned, as well as a general overview of ROMM Incorporated's time in the BSG simulation in Industry 2. If you have any questions, you're welcome to reach out to us through email. Thank you.